Welcome to another episode of Policy and Profits. I'm economist E.J. Antoni, and it's my pleasure, as always, to be joined by the one, the only trader extraordinaire, Anthony Esposito, my patriotic friend. Anthony, how are we doing this week?
Oh, thank you, sir. Doing well. I actually had a phenomenal week. I was able to get down to D.C. from my home in Philadelphia and for a great U.S. Oil and Gas Association event. And guess who I got to see at the event with the Secretary of Interior on Tuesday night? Let me give you a hint. He's dashingly handsome, has the best goatee on the East Coast, and is the best dresser I've ever met, and the best economist I've ever heard.
I got nothing. You're
my friend.
Too kind. Seriously, you are too kind, Anthony.
No, it was great seeing you. Definitely a great event, and it was great seeing you there. It was a very. I was looking forward to being there for the event, but whenever we get to kind of cross paths in person, it's always a good time. So, definitely good seeing you, and thank you very much for the time that you bestowed upon me in conversation over that delicious drink.
I know, seriously, the pleasure was all mine, and it was great seeing you. It was great hearing from from Secretary Burgum. It really is amazing. It gives me a lot of hope, I guess is probably the best way to put it. When I hear all the tremendous work that's being done behind the scenes in this administration, the stuff you see on the news is like, all right, we signed an executive order, or you can see that the House or the Senate is passing a piece of legislation. You don't see all the deregulatory efforts. Right. He's telling us a permitting process that used to take 2 years, they managed to reduce to a little more than a week. I mean, that's amazing. Think about the economic savings there. Where a big business, even a small business, typically they can't afford it, though. So let's say a big corporation is spending how many millions or even billions of dollars on attorneys mostly to try to work through a permitting process that takes that long. I mean, that's an obscene expense. And the longer those projects are delayed, it means the jobs that would have been created are delayed. The revenue that would have been generated is delayed. Whatever product or service the consumer would have gotten, that's delayed. I mean, that's really, really positive news. And there's just no way to find out about stuff like that, I think, until you actually hear from somebody like the secretary.
Yeah, and you hear from him directly is just amazing. I mean, it's that whole idea of taxes, tariffs, and then deregulation. But I think the thing that I took away from that talk too was it was, he was discussing exactly what I took away was really the business-like approach that they have, the private business approach that they have. And I heard that the next day from Secretary Duffy and Secretary DeRemer. They all have a very, almost like the public sector typically is like, we're going to get to it. We'll get to it. We'll get to it. The private sector is, let's get it done yesterday because we need to make money and we need it done. And that's my big takeaway from all of them. And I was lucky enough to meet all three. They have a very private sector, we're getting this done now type view, and they're moving. And there's not the idea that the media kind of tries to put out there that President Trump, even with the tariffs, that the tariffs were random. They didn't think through the numbers. The numbers were too easy to get to, and this is how you back into it. And I don't. Some of it may have been how they got to the number, but I will say that the idea that it's random and he's just kind of throwing stuff out there. Nothing being done here is random, and nothing being done here is by accident. He is working through a process, and he's really playing 4D chess, as most of the other countries and adversaries are playing checkers. There's a few exceptions there, but he is definitely way ahead of his game, and the cabinet that he's put around him is definitely, as far as I can see, for the most part, they're really following suit and doing the right things and doing it well, which is phenomenal. The question today, and what I'd like to get into is, and I'll get into the kind of the profit side of it, but this is going to kind of mix together today, and I like it. Yields have been something that we've talked about quite a bit for most of the time that we've been running the podcast, and for most of the writing that I've done and what you've talked about. You talk about the Fed funds rate, and that's important, but that's really been the shiny ball for the market and kind of the chase, and that's been the case for honestly a quarter of a century at this point. But we're starting to look at yields now in the bond market. We're starting to look at the 2s, the 10s, the 30s, and it's really becoming an issue, which is becoming more concerning for me, to be perfectly honest with you. Initially, I thought there was an unwind of a carry trade, and that's why we had seen yields start to come down on the 10-year, and then yields started to spike back up. I thought that was just the selling of, or the unwind of a levered trade, long treasuries, where now treasuries were getting sold and yields were going up. But we're starting to see something a little different now, and I really want your take on it. And I'll go into it with this. We have a little snip up. You had made a comment on a zero hedge quote on the 20-year, which I want to get to. Before, as we have that up, I want to note that the 2-year is now at current levels, the highest it's been since 2007 at 399.
Oof.
10-year is at 456, the highest it's been since 2007. And the 30-year is at 506. So over 5% on the 30-year, the highest it's been since June of 07. So all of these, the yields on the 2s, the 10s, the 30s are screaming higher. I want to get your take on this. What are we actually looking at? Are we looking at no demand? Are we looking at foreign holders, which may have been more strategic holders of treasuries, now crushing treasuries and taking that? It looks like they're kind of flowing out into gold, and that's been the case for the past few months. But are we in the seventh inning here, or are we really in the first or second inning here? And what's going on?
Great questions. In terms of what's causing the jump in yields, I think it's a little bit of everything, right? Yes, you are seeing that reduction in foreign demand. Some of that's actually just a continuation of an existing trend, right? China, I think they peaked in terms of their U.S. holdings in like 07 or 09, and they've been allowing them to taper since, to run off. Essentially, they're letting those securities mature and just not replacing them. Are some countries now engaging in active selling? Sure, but again, they're not flooding the markets. That's not the primary cause. It's not helping, but it's not the primary cause. But what really seems to be the case now is investors are becoming aware, as we see the current bill going through the reconciliation process, the big beautiful bill, is that we're just not cutting enough spending. A lot of the reductions that we thought we were going to get are not materializing. Now, maybe we end up getting those through rescissions. So that's where the president essentially sends a package to Congress saying, I want to cut 1, 2, 3 right out of the budget, things that have already been authorized essentially. And then you just need a simple majority for it. So you don't have to worry about the filibuster in the Senate. Maybe we'll see that. I'm not sure if that's the case, though, why they wouldn't just include it in the reconciliation package. But whatever the case may be, investors are picking up on the fact that we're not cutting enough spending. And the issue here is that it's not 2019 anymore. If we were looking at this current tax package with a 2019 budget, it'd actually be pretty good. In fact, I'd go so far as to say it'd be really good. The problem is that we spent 4 years just exploding the federal budget with all this discretionary spending, all this nonsense, garbage, things like green energy tax credits, all the all the DEI, the woke nonsense, tons of foreign aid. I mean, you name it. The last 4 years have just been boondoggle after boondoggle, and the result of that is now all of that stuff is essentially built into the budget. So if you don't start cutting it out, you are not only looking at an unsustainable path, but unsustainable levels for government spending. And we are look at these yields that you were just mentioning, 5%. Yeah, 5%. We're at about 36.2 trillion for the debt right now, the federal debt, and Treasury cash is down to, I think it's about 500 billion now. So basically, as soon as the debt ceiling is lifted, you're going to borrow somewhere around another 400 or 500 billion to replenish the cash that's been depleted from the debt ceiling being in effect. But then you're also going to need to borrow a couple $100 billion more just for regular spending that's going to come out. What I'm trying to say here is you are almost overnight going to see the debt go to 37 trillion, and you're refinancing it at 5%. Yeah, that's about $1.8 trillion a year just in interest. So, all right, so the bond market is looking at this and saying, oh, heck no, right? There's no way they're going to be able to continue paying this long term. You're either going to have to do a literal default where you're just not able to make the payments, or you do what I call an implicit default, which is an option that sovereign debt has that other kinds of debt don't, because sovereign nations get to issue their own currency. Yeah. And what you're getting paid today on a bond compared to 4 years ago are dollars that have lost a fifth of their value.
Yes.
That is nothing less than an implicit default. So now bond markets are going to say, all right, we got to price this in. Mm-hmm. We have to believe that the Fed is going to become the marginal buyer, essentially, of U.S. debt going forward. And that's going to repeat the inflationary nightmare that we've seen for the last 4 years, basically everything we had under Biden.
So print money, use those dollars, newly printed dollars, increasing money supply, increasing inflationary pressures, print money, step into the treasury market, buy bonds because we need to support the treasury market because yields are getting too high, and actually complicate the issue further, is what you're saying. Is that
100%? And if we look at the secured overnight financing rate that we got today, it just dropped. Now I get it only dropped a single basis point, but this is something the Fed tries to control really, really tightly. Yeah. And it's now down to the lowest level since I think December of 22.
Okay.
So I mean, this is not insignificant here. What's going on, and I think the Fed is really primed and ready to dump all the liquidity into the market that the Treasury needs, and that may sound comforting. It's not.
No. So as we pull up the next chart, because this isn't just a U.S. issue, this is a global sovereign issue. Mm-hmm. We have yields screaming across the board. For me, that's, again, I'm trying to wrap my head around what exactly the result will be, what exactly the trade is, and what exactly the damage is. But I mean, we have global 30-year bond yields. We just pulled it up from Europe to North America to Asia.
Great chart.
Also, yeah. I mean, it's phenomenal. Actually, it's really awesome. So we look at that. Like, this isn't just a U.S. issue. I would say, actually, it's a question. The implicit default that you just spoke about, and correct me if I'm wrong, but isn't that exactly what we did and why we came off of the gold standard? Because we couldn't repay the debt that we had. And by having the dollar pegged to gold, we kind of had a noose around our neck. So we decided, okay, we'll just unpeg the dollar and debase the currency and then just pay back with dollars that weren't worth as much. So we're technically paying it back, but not in real terms, not what it was supposed to be. Am I totally off base there, or is that essentially?
No, you're totally on target, Anthony. That's exactly right. You know, it's so ironic. We remember Paul Volcker as like the inflation slayer, right? Mm-hmm. And like the history books let him wear that crown. We forget he took control of the Fed almost 8 years to the day after he helped convince Richard Nixon to close the gold window, to sever the last connection between the US dollar and gold. And the reason they had to do that, well, they didn't have to. The reason they chose to do it was because the federal government was spending so much money we didn't have and flooding international markets with those dollars that foreigners kept coming to the U.S. to redeem those dollars for gold. Because even though U.S. citizens couldn't, foreigners still could. That's the only way we were able to establish a dollar gold exchange standard in the Bretton Woods Agreement after World War II.
Yeah.
So essentially, we were going to run out of gold. And so they made the decision, instead of doing the politically difficult thing, which would have been cutting spending, they did the politically easy thing of saying, okay, we're just going to close the gold window. Of course, they said this is only temporary, right? It was an emergency measure, and nothing is so permanent as a temporary government program, as Reagan said. And what happened after they did that? The dollar price of gold absolutely skyrocketed as everyone figured out the dollar has no real value anymore because you can't exchange it for anything.
No. And it really brings to light when we say, and not only us, but when people say, and we've said it a ton of times over and over again, that the problems that are trying to be fixed here, the system that's trying to be corrected here, is a multi-decade problem. It's not, I mean, Biden was a disaster, let's be honest, across the board, including the million jobs that they made believe were created, which now we see were not created. But it was a disaster. Having said that, our policies in both parties, I mean, Dems and Republicans, we have led the country down a very destructive path now. And it's really, we're coming to the edge of the cliff and we need to make a call. And the fact that, President Trump and the administration are making a hard right to avoid falling off the cliff, everyone's complaining and freaking out and not understanding. But these conversations really show you how deep the rabbit hole is and how far back the rabbit hole goes. I mean, there's a ton that needs to be fixed. So when we talk about policy implementation and fixing to policy effect, yeah, there's going to be a stretch of pain here. There's going to be a mess. Yeah, the risk markets and equity markets are the mop and clean up in aisle 7, which I love saying. I don't know if it's that funny because no one ever laughs, but I laugh.
I like it.
I mean, listen, we're the mop, and it is. We have decades of issues and bad policy layered on top of each other. It's like an onion of really bad policy and problems that we need to peel back. The markets reacted yesterday to the auction as expected. So we're talking about yields being higher. We're talking about concerns as far as debt, concerns as far as inflation. We have a chart up yesterday, which was put out. I think it might have been Kobayashi letter. I'm not sure, but we'll pull that up. And it shows we had the 1 o'clock bond auction, and then we had the reaction to the S&P. So you can see the top arrow is the 1 o'clock auction. And we took an 80 point hit. We were down 80 handles pretty aggressively just coming out of that bond auction. Now, what's interesting here is we've been kind of on the cusp of worried maybe about yields, but it just hasn't been come through. So now we've had a market rally from the 4,800 level all the way back up towards 6,000. Right, it was an amazing rally. Market was down over 20% peak to trough, and then we've rallied back now to within 3 percentage points of that peak. Absolutely amazing. And I have gone through the market and gone through my morning letter and run the portfolio accordingly. Most of the move, from back in December through really a week and a half ago, I was running the portfolio on the S&Ps short flat, meaning there was no rally that I wanted to buy because of the overarching regime we're in. So if you consider the regime as a bear regime, you don't want to get sucked into bear market rallies. That's not the game that I play. So about 4 or 5, maybe 6 days ago, I said I'm normalizing the call where I would be long short flat, just because there's been so much repaired technically and so much work done, quite honestly, from the White House that I didn't expect to be done that quickly. So normalized the call about a week ago, and I've been running now from that time long short flat. The sizing there is part of what I do as well, so I can size differently, but I'm willing to get long on the calls. About 4 days ago, now I'm in my 4th neutral day. 4 days ago, I issued that we were at a neutral, and I started to talk about the fact that I was looking at negative divergence as we were testing 6,000, negative divergence between price and market internals. And I have that post that I put up here just to show kind of where it is on X and the fact that I issued it like I issued my report every morning. But I had written out on X, May 20th was this report. That was my second neutral day count. You can see at the top, I kind of track everything for whoever's reading. And I had said that although the index doesn't look ready to fade, internals continue to display negative divergence and would suggest that the risk of a reversal to the downside is growing. My momentum and trend indicators are flat to fading. Spot VIX and VIX term structure models were risk on at that point, but they are sometimes move aggressively. So they're more anecdotal for me in the portfolio. They're not trade signals. And I was focused on 2 levels, 6,000 resistance, holding as resistance, and then 5786, which is the gap up day. There's a gap below that. That was the May 12th day, the low for May 12th. So essentially back on the 20th, which was 3% ago, because now we're down 3% peak to trough, I started to see negative divergence. So what exactly does that mean? What that means is, in my world, the way I look at the market, I was noticing even ahead of this auction, which it kind of becomes, the headlines are interchangeable, like I always say. So even ahead of that, what I was noticing is that price trend, momentum were moving in opposite direction. So I was watching price grind higher, start to hit its head, but look like it wanted to really test 6,000, while trend and momentum, the indicators that I watch, were starting to break down or flatten. That to me is negative. That's not what you want to see. As you see price grind higher and rally, you want to see confirmation from trend and momentum. You want everyone involved. You want everyone excited about it. That's not what we saw. We can pull up the chart of the S&P from the 20th, so 2 days ago. I was actually traveling to DC with you, so I didn't have a new chart to pull up. But you get the point. We're kind of up just price. And what's important here is we're hitting our head up at 6,000. I was watching negative divergence within internals and then within my model. Mm-hmm. And we're now within 3 percentage points of an all-time high. Are things really 3 percentage points from that good? Well, they weren't that good when we were there before, and not much has changed. So my answer would be no.
Right.
We went neutral. I came out of a very brief long position. And in that neutral call, waiting to either have a shift back to neutral or on the reversal, looking to get short. We're also within that red rectangular formation on the left of the chart is actually the topping pattern that I had been talking about back in December, January, February. So we've broken back into that. We've broken about halfway through that. It's kind of a sensible place for us to fade. And as I mentioned back a couple of days ago, that negative divergence was becoming a concern. Now we're watching the headline become the bond market and yields, and we're watching the market start to fade. So will we break down? 57.86 is the level. We need to hold that. If we don't hold that, as I wrote this morning, we should see accelerated selling to the downside, and that's going to bring 5,700 into play very quickly. And if we don't hold there, then we obviously have some gaps down with the way we've rallied up. But the yields are definitely a concern. They're the new concern. And we have the tax bill kind of making its way through Capitol Hill. Yields are an issue. And we'll start to see those headlines pop up now as far as GDP growth, stagflation, inflation. There's a lot of concerns out there. To be 3% from the peak did not make total sense. And now we'll see how well internals can recover. I will say that the Ascalon momentum trend model, which I've announced, we've changed our corporate structure and our name, and we're in the process of a complete rollover. But Island Capital is now Ascalon 6 Capital. The ACAP model is close to turning negative. A negative shift here, and if we see internals continue to break down and a break at 57.86, things start to pile on, and it could get a little nasty. What I will say in closing on the market, and I've seen a ton on this, and it's really interesting. Since December, we have seen all-time highs in retail buying, and we have seen all-time highs in institutional selling. If I were to bet who's right, I would bet that the institutions are right and retail is wrong. And you can look at Bitcoin as a risk barometer. Bitcoin now ripping above, I think, 111,000.
Right.
And all the gifts are back out on X, and the people dancing and all the, like, that's not really, that's gambling. That's kind of, aggressive risk trading. And I don't know how much, the only thing I read from that is that the retail risk appetite is massive, and the funds and the institutional investors are still selling, and on net they're paring down and getting out of equity positions. So I would bet we have more to go to the downside. I've continued to say that. The technical repair has been much quicker than I expected, on not only on the short term, but the intermediate and long term. But we're not out of the woods, and the greater regime, in my opinion, right now is still a bear regime. So be extremely careful.
So Anthony, one question I have for you on yields then. I get this sense that because if we go back, we remember April 1st, before the whole reciprocal tariffs were announced, before Liberation Day, there was a conversation about yields then. Now, they weren't as high as they are now, but yields tanked after all the tariffs were announced because people were afraid we were about to go into a global recession, right? So now all of a sudden the bond market starts pricing in those negative economic outcomes. And do you feel like, or do you think maybe that essentially kind of delayed what we're seeing today? In other words, yields would have gotten a lot higher a lot sooner but for the fact that people had all these recession fears, which now, I mean, it looks like we're going to get trade deals, and obviously that's good overall, but it means that recession concern, global recession concern, goes away. And now, I don't know, it almost seems like now there's nothing to hold back those yields from going higher.
I would agree with that. I don't think the Moody's downgrade along those lines was really a revelation. They were years behind the other rating agencies, but I think it kind of piled on. And I would agree with everything you're saying. I think that we're in a position now where yields look like they could really break out and go higher. It's funny. I didn't think that they would initially. When we saw them coming in, I thought that would be the movement. And I thought that would be the case because of a change in regulations at the banks, and then a change in duration distribution or duration issuance from the Treasury. There was a way to kind of move through it, I thought that's what they were trying to do. Having said that, I did write an article with the CMT Association, of which I'm a member, back in 2020, I want to say 22. And the article focused on the 10-year yield. I actually was thinking about this last night, and I said it to my wife. At that time, I had said that we were, which this isn't brain surgery, this is not, brain surgery, but we were breaking out of a multi-decade, probably a 50-year bear market in yields. And then I had done some work on regressions, and I remember writing that article. I can pull it up next time. I'll show it, or I might throw it out on X. Writing that article, and I had a measured move to 6.3% on the 10-year yield. So thinking back to that on a purely technical basis, we are set up for, in my opinion, 6.2, 6.3%. That technical analysis hasn't changed. So I can see us definitely moving higher there for sure. And the setup seems to be evolving that way.
I mean, you think this could not happen at a worse time?
Yep.
When we think about how Janet Yellen, our favorite Treasury Secretary ever, right? Be still your beating heart, Anthony. I know how much you love Yellen.
Love her.
She essentially, and we did a couple of different episodes on this last year.
Yeah.
She essentially took debt that should have been getting issued at longer maturities and just threw it all into T-bills. To not only try to do yield curve control to keep down the rates on things like the 10-year or the 30-year, mostly the 10-year, but then also because she'd rather have T-bills circulating because they're treated more like cash, right? They don't have the same liquidity premium that the longer dated treasuries do. So it was kind of offsetting some of the monetary contraction being done at the Fed. You had this fiscal expansion, if you will, to offset the monetary contraction. Yeah. We talked about some estimates were that she basically added the equivalent of like $1 trillion of liquidity to markets. That's huge, especially in an election year. Now this all got dumped in Bessent's lap, and he's having to refinance all those bills because the longest maturity is 52 weeks. So anything Yellen issued last year, by definition, is going to come due this year for bills. And now what's Bessent do? He's stuck. I mean, he has no good options here, right? You're talking about rates over 5%, and he's trying to convert a bunch of these T-bills into longer maturities. Yeah. I mean, he literally has no good options here. She backed him into a corner where the only option he has is to refinance the debt in a very, very expensive way.
Yeah. Yeah, it really is. When she alone oversaw 16 trillion in debt creation. Somebody to step in so irresponsibly, the whole modern monetary theory that we can issue as much debt as we want, and we can be as irresponsible as we want, and we'll just tax our way out of it so we won't see inflation. The fact that somebody that is in tune with that, believes that, and functions like that to run the United States Treasury is actually the disaster it is. I mean, and then to leave and kind of wave on the way out and go, oh, I think you guys might have a debt problem. It just treasonous, in my opinion, really treasonous. I don't know exactly what she thought was going to happen. I don't know exactly what Powell thinks is going to happen. But it seems like no one really cares. This is about politics. It's about power, and it's just a destruction of the system. So yes, to your point now, Bessent is in a position that he does not want to be in. I do have faith in him. I think that he's handled himself extremely well, whether it be really at the Treasury or trade so far.
Hmm.
But this is a challenge, and I think we're seeing it in the markets. I mean, we have the front month futures, the June contracts now at 58.55 right now. Cash S&P is at 58.39, down from 61.50 at its high, right? Down from almost 6,000 a few days ago. These are all shorter term things, but I do think that the markets are realizing that we're not out of the woods yet, and there's some room to the downside to come. So definitely not an easy predicament to come out of. Definitely going to be some cleanup and some pain. And as the markets kind of get out of this retail driven bear market rally, which has been ridiculous. So God bless anyone that was in it and made, 18% on the move. Not many people did, but if you did, God bless you. Just beware, because this is kind of that FOMO moment. You will mess around and find out.
Right.
Oh, FOMO. Hold on. That's fear of missing out. No.
Yeah.
What is it?
Is it the FAFO?
Oh, FAFO.
Fool
FAFO. Yeah,
around,
that's
find
it.
out.
That's it. Oh my God. My 17-year-old daughter would hate the fact that I messed those two up. But this is that FAFO moment. You have to be really careful, because the market is the market powers are understanding that this isn't completely clear.
So Anthony, with that, that great technical analysis of looking at probably 6.2 yields, right? 6.2%. I mean that sounds absolutely terrible for markets. I assume that's your assessment as well, right?
Yeah, I mean, if that analysis proves to be true and we see the 10-year above 6%, that's going to be disastrous for markets. That will be. We will see.
What does that do for mortgages?
Mortgages should be moving much higher, right? The 30-year fixed is pegged to that 10-year yield much more so than the Fed funds rate. So we're going to see mortgages continue to move higher, which is going to be a continued problem on the housing market, which is in trouble as it is, as far as rates, as far as inventory, and as far as sentiment. And that also presses a consumer that is way overextended and, kind of dying on the vine. Not to sound, I'm not saying that because I'm happy to say that. I'm saying that because that's the reality of our situation. We're a consumer-driven economy, and a lot of that consumer sentiment and spending comes from our homes. That's the one thing people own. That's their largest asset across the board, is their home. If that market starts to really tighten up more, we could see some real problems. And then you can forget delinquencies on credit cards, delinquencies on student loans, delinquencies on auto loans. Like there's a lot to go down. There's a lot to talk about. But yes, I think that the yields on the 10-year rallying higher and above 6% would be a pretty stiff one for the housing market and for mortgage rates.
Yeah, I mean, and the housing market, which again we've talked about that one before, what terrible shapes that. And I think we just got I forget if it was the pending home sales numbers for April or if it was the existing home sales. So if it was like essentially it was existing, okay, yeah. And that was I think that was the worst April since the housing crisis.
Yeah,
right? This is not good. You look at home builder sentiment. That obviously one is new homes and the other is existing homes, right? But in everywhere you turn in the housing market, it is under so much pressure right now, and there's just a lot of pain. It's amazing, going through things like the home builder sentiment and seeing the number of respondents who have given up trying to build starter homes, for example. They're like, no, the only thing that's profitable right now are luxury homes. So that's all we're going to build.
Yeah,
I mean, it really is disturbing.
Yep. Yeah. We definitely have. Oh, here's actually a snip from my, that's fantastic. This is a snip from my report on the yields and that technical analysis from 2022. So you can see that at the end of this was the conclusion of the report, and I was calling for 6.4% on the 10-year yield. So I can pull that report up. I'll put it out on X if anyone cares to see it. But this is the conclusion of the article that I wrote about 3 years ago, 2.5 years ago. So definitely all great points, EJ. I think you're as usual spot on, and it is definitely, it's a scary spot. We'll see how we move through it, but definitely appreciate your insight and definitely appreciate all of the color here. It's going to be interesting. Thank you, my friend.
No, thank you, Anthony. Pleasure is, as always, all mine.
I will talk to you next week. And if I'm back in DC or you're in New York, please let's grab another drink.
Another drink and a steak dinner on me.
Always, always. Thank you, sir.